Should you be betting on Canada? In today's video, we're going to be talking about that exact question. Should you be betting on Canada? With all the things going on in the world right now, that's actually kind of up in the air. I've always been a big bull in Canada. This entire channel is dedicated to Canadian investing, and still, I'm left questioning, should I be betting on Canada right now? Is this where I want to put my money? Well, today we have two different investment analysts, big important investors, institutional investors who have gone on to BNN Bloomberg and are going to tell us a little bit about why they're investing in Canada, what exactly the trends they're looking for, what the markets are, sort of the expectations they have, and where exactly they're putting their money. And I think this is really valuable. Welcome to Golden Arch Investing. My name is Liam. On this channel, we talk all about Canadian investing. If that interests you, please do subscribe to the channel and like the video. It means a huge amount. Doesn't cost anything. Like I said, we're going to be going through a couple of institutional, big, important, and much more skilled investors than myself. And we're going to review kind of what they're saying about Canadian investing. I'm going to talk about how I think it might apply or not apply to me and maybe to you as retail investors, and my opinions, right? Do I agree with them? Do I disagree with them? Just as a retail investor, as somebody who does this, huge interest in it, sure, but not a professional institutional investor. So in the video that I'm going to put on the screen right now, we have a gentleman who is coming from the UK. He's talking about the Canadian market. Kind of a misleading title to this video. He's really talking about why he thinks Canadian stocks are going to outperform, not necessarily the market as a whole, but I'm going to let him take it away here.
Now, as we are in the midst of our first trading day of 2025, our next guest says Canadian stocks are much better positioned than their U.S. counterparts when investing in 2025. For more, we're joined by Gavin Graham, Chief Investment Officer and Portfolio Manager of Spire Wealth Management. He joins us from England. Gavin, great to see you. We haven't done this for a while.
Great to see you too, Mark. Nice to have you back. And yes, it's been a really remarkably strong couple of years for North American markets, US markets in particular, especially the Magnificent Seven stocks. It seems fairly optimistic to expect a repeat of that this year, and therefore looking at something like Canadian stocks, which are much more attractively valued, would seem to be a sensible choice.
Right, and we'll move into that.
Okay, first pause of the video here. I wanted to talk about what he just said. Been a great couple of years for North American stocks. I think we can all agree, right? I think the S&P 500 was up, 25% last year. It also had like a 20-something% the year before. Absolutely fantastic. And it's been led by the Mag 7, which are, of course, the biggest 7 American, really, tech stocks. Now, he talks about how they've been doing so great, and therefore it's a little optimistic to think they're going to be doing great in the future. Do agree with that on some levels, right? But obviously, people have been saying that for a while. So I do want to point out, I'm not necessarily endorsing that statement on its own. I think it's really important to do your own research, decide if you really love these companies or not, as we sort of move through and decide if these kind of investments are things we want to follow or if we're looking in other directions. Well, he's looking specifically at Canada, and I'll let him get into his next point here.
But speaking of the Mag 7, you're looking at the concentration, essentially those 7 companies making up nearly 20% of global market cap. And you make the comparisons, and others have too, that valuations are similar to where the Nifty 50 were trading in the 70s or the .com stocks in the late 90s. So can we extrapolate from that, Gavin, that they're in the most expensive stocks, the Mag 7, could there be tepid returns the next few years potentially?
Absolutely. And again, and as you say, I'm by no means the first person to be pointing this out. Valuation is not particularly useful in terms of timing, but it is very useful on a longer term view in telling you.
Okay, huge. I really wanted to stop right there and point that out. Valuation is not necessarily useful when it comes to timing, but is hugely useful when it comes to long term. People have been talking about the overvaluation on particularly growth stocks forever. People always say, oh, these are way out of, reality, right? The PE multiples on these companies are ridiculous. Why are they being priced to perfection? It can be really challenging to make a timing judgment on that because the market can be irrational. We've seen irrational markets in 2021. We've seen them in 2024. We might see another one in 2025, where the market is just like euphoric. They just can't wait to have all these these growth companies explode up and make huge money off them. So PE is very useless when it comes to timing things. But if you're looking at long-term investments, it's a great metric, particularly forward PE, particularly if you're taking into account the kind of growth that's going to happen. I think it's a really interesting point. Don't just make investment decisions based on PE. You're going to miss out on so much value. But if you're looking at it over the long term, it is a good metric.
What your returns are likely to be. And we are in the top 5% of the most expensive markets in the last century, including, as you mentioned, the Nifty 50 in the early 70s, and particularly the internet bubble in 99, 2000. And the returns you made over the next 10 years from markets were in the region of 0 to 3% per annum, and that included dividends. If you pay a really high price for something, the returns you get will not be very attractive. And I make.
He's right. If you pay a really high price for something, the returns you get are not going to be attractive. But really good companies are often priced high. So if you're looking at buying a already well-established, really powerful, really strong company, you're not going to get it for a really low multiple. You're still going to have to pay a higher price. You just have to pick your timing maybe a little bit more cautiously, or just average in over time as the ups and downs that come with market speculation come.
The comparison with buying government bonds below 1% in the middle of the COVID panic back in 2020, and you had no protection at all in the event that inflation came back. Oh, look, inflation came back, and you ended up losing 20% of your money in the government bond market in 2022. Now, bonds actually look relatively interesting because they're paying 3.5%, 4.5%. But again, if you buy something when it's really expensive, you won't make very good returns going forward.
All right, Gavin, back to Canada, where you see better value. You like certain sectors, and some of the names you're mentioning here in financials, RBC and Manulife, Capital Power, Enbridge, REITs. Can you elaborate on your concept here that Canada is a better place to be?
Yeah, for a start, even though it did pretty well last year without having any of the Mag 7 stocks, I think the TSX 60 was up 18% against 25 for the S&P 500. It's got a big exposure to financials and interest rate sensitives. And obviously with rates coming down, we're down remarkably enough, 1.75% in Canada. Canada's been the market leader in cutting interest.
So here he's talking about something that has been a trend over the last year. People who are betting that as, interest rates go down, all these companies that are sensitive to interest rates, your financial institutions, your utilities, your REITs, anybody who takes out large amounts of debt to run their business, they're going to benefit. I don't think that's a new story here. Now, maybe you're saying that the Canadian market hasn't priced it in quite as much as the American one already did, but this has been on the headlines for months, if not years now. It's been like, oh, we're going to buy this because the interest rates are going down. Oh, we're buying this. Well, interest rates have gone down quite a large amount in Canada over the last year. And while some of these sectors are still lagging a little bit, he's going to talk about REITs in a moment, most of these sectors have seen pretty great returns based on somewhat the speculation that interest rates going down are going to benefit them. So really interested to see sort of where he goes with this. He'll show us a couple of sectors here that are really interesting to me, but I just want to point out, don't just invest because interest rates are going down. Use that as a little bit of a tailwind when you're picking your investments.
Interest rates, perhaps because the Bank of Canada is distinctly worried about the slowing Canadian economy and the effect of high interest rates have been having on the consumer. And as a result, the interest rate sensitive sectors, which is pipelines, utilities, financials, REITs, telecoms, actually are starting to do better, although with the continued increase in 10-year government bond yields, ironically, the Fed cut rates 100 basis points in the last few months. Longer-term bond yields in the US are up 100 basis points, which might reflect the fact that there's going to be a very, very large amount of US government bond issuance. But either way, the financial sectors have started to do better. The pipelines, the utilities, the financials. In fact, some of the strongest performing stocks have been things like World Bank, National Bank, Manulife, and the same thing in the States. And realistically, there's going to be further interest rate cuts. So these interest rate sensitive sectors look good. One interesting area, you touched briefly on the REITs, both retail centered REITs and apartment REITs have actually been lagging somewhat, even though interest rates have been coming down. We all know the difficulty of getting.
So interesting thing there. I do really want to talk about REITs more here on the channel. He's talking about retail REITs. He's talking about apartment REITs. Okay. I think there's also been a lot of sort of collateral damage from the loss of office space, and the damage to office REITs might sort of be part of the reason why it's doing worse. Also, retail REITs, obviously, huge difference between sort of A grade retail space and B and C grade retail space. The same way there has been in office, right? Obviously, but tough sector to talk about. That's why I haven't talked about it here on the channel, because honestly, as I dig into it more and more, I'm just more and more struck by how important specific properties are to these companies, and the sort of world of REITs is just kind of foreign in contrast with the world of just stock market investing. Really complicated stuff. Would love to talk about it more here.
Rental apartments in Canada, and retail, especially grocery-based retail, has proved to be extremely resilient. So those sectors of the REIT market look really interesting.
Now, in the energy sector, Gavin, specifically with natural gas, which has been quite hot lately, in part because of expectations of much colder weather in the U.S. in the next couple of weeks. But a couple of names you mentioned are Peyto and Tourmaline. Do you have some preference there?
Well, Peyto, actually Tourmaline has been the better performer, and is probably the most fashionable pick, as it were, and done really well. But Peyto has done really well, and again gives you a really good running yield, and it is the lowest cost gas producer. So therefore, even when you had a big sell-off in the price of gas in 2022, it still actually was able to be cash flow positive and very profitable.
So obviously, I've talked about Peyto. I think it's the most recent video on the channel here. Love the company. Really, really interested in what they're doing. They're a great low-cost producer, but he's right. Tourmaline is the number one name. And quite often, and it's not bad advice, people pick the number one player. Pick the big guy, particularly in a market like this where there's all these like headwinds and potential risks coming. Big guy usually has the best costs. One of the reasons I like Peyto is that their costs, their actual sort of cost basis, the price they can sell natural gas at and not lose money, is the lowest. And so they kind of have that almost like the big guy effect, even though they're the smaller company. Really interesting stuff. Like what he's talking about there. And he's right. Natural gas has been up huge. So might be a great thing great time to buy. We'll see.
To maintain its dividend. So those are sectors we think look interesting. And realistically, also, of course, we've just had Ukraine ending its supply arrangement with Russia. So European gas prices have started to spike. It's quite cold over here in the UK. We've actually, remarkably enough, got snow, which you almost never get in the UK. And that's likely to put a bid under gas prices generally. But as you say, it generally tends to be pretty much a local weather-related market in the short term in North America.
And then, Gavin, on the precious metal side, you recommend that investors should have about 5 to 10% of their portfolio in gold miners. I'm looking at Agnico.
This is one of those things in this video that just makes me confused. 5 to 10% in gold miners specifically. I don't know exactly what this gentleman's firm, or who this gentleman's firm sort of is aimed at, like what his client base looks like, but man, that's specific, right? Like 5 to 10% in specifically gold miners. They've done great, but it's a cyclical industry. You're telling us to buy now when gold's up the most it's been in however long, all-time highs recently. So I'm really interested by that take. I'd be interested to see sort of what the strategy is behind that. Just wanted to pause there because that made me just shocked.
Eagle, for example, year over year, up 63%. That sounds pretty robust, but do you think that the gold miners have actually even kind of underperformed gold, which was up 27% last year, best performance since 2010, that these miners could do even better?
They could. For a start, gold actually beat the S&P 500, not the Mag 7, obviously. And yet, money's been coming out of gold ETFs. I'm not sure whether you saw that, the Spider Gold actually has less gold in it than it did at the beginning of last year, even though gold's up 27%. And while individual well-managed stocks like Agnico, which is one of my largest personal positions, and has been a long-term recommendation, have done pretty well. Barrick and Newmont, which are the two big North American gold miners, have actually been unable to get out of their own way because they've had production issues and corporate governance issues and the rest of it in Africa. So gold mining stocks are at their cheapest relative to gold virtually in their history, and certainly for the last 10 years or so, which is slightly odd because they're a leveraged play on the price of gold, because if the price of gold goes up, every single additional dollar on an ounce of gold should drop straight through to your bottom line. So you ought to actually go up 2 or 3 times as much as gold, which is what tended to happen in previous gold bull markets like the early 2010s and 20.
I'm going to pause there for a sec. Really interesting. He's pointing out that the price relative to the price of gold, so the price of like an Agnico Eagle relative to the price of gold, is sort of at the cheapest it's been. I think it's got to be relative though, because there's all these other options out there that people are preferring. So maybe he's got a point here. I've talked about Agnico Eagle. I'm bullish on that company. No real reason to argue with him on this. I still just think the 5 to 10% is a little ridiculous. Like such a specific number for his clients.
2020, but just not really been the case so far. So Agnico, Alamos, Pan American Silver, Franco-Nevada, we think look pretty attractive. And by the way, you're getting paid reasonable dividend yields now because they are using their excess cash flow not to make overpriced acquisitions, but to actually give it back to shareholders.
Lots of ideas there, Gavin. Thank you very much, and have a great.
So as we wrap up this video, we're going to go into an article here from BMO. Actually, it's from Bloomberg. The article is sort of interviewing a BMO chief investment strategist, talking about the Canadian economy, talking about his picks and what he thinks is going to happen for the TSX. He also is pretty bullish. But I do want to pause for a second and point out a couple of key things that I saw in this video that we're going to then sort of look at the BMO article. We're going to see what they're talking about before we wrap up the video. But key things here. He's not saying Canada's economy is going to outperform, regardless of what the video is titled. Canada's economy is not anything to do really with what he's advocating for. He's saying that investors should be looking at cyclicals that are on the right sort of turn as they go up, right? That's the cycle is constantly up and down and up and down. He's saying, hey, Canadian cyclicals are on the way up, specifically natural resources. He also does point out, not so much in this video, bullish on financials. Partially because of the whole interest rate thing, but also just bullish on financials. He talks about even like the Manulife, the insurance folks, bullish on those companies as well. Not just big banks, but sort of all of the Canadian financial giants he's bullish on. He talks about his bullishness on utilities, energy specifically. He mentioned Enbridge briefly at the start there. I can imagine why. Again, we're looking at the same kind of information when we're dealing with these interest rates going down, same kind of bull case. And obviously the ones he points out, and he talks in detail about, things like Peyto and Agnico Eagle, those are companies that are going to benefit from increased commodity prices, probably. Again, commodities, we never really know, but probably. And cyclical market on an uptrend, benefiting from interest rate decreases. All sorts of good stuff. Okay, so we have our second article here, and it's a little bit different because this time BMO, or at least their chief strategist here, is predicting the TSX specifically to gain 15%. Now, what's interesting about him saying that it's going to go up 15% is that he's arguing it's going to surpass the S&P 500. And he's saying that's happening in 2025. So he's not only being bullish, like our last interview was, but he's also giving a time frame and a target. Huge. Let's scroll through here. So he's talking about how the TSX has been lagging behind the US stock market, I think largely because of the huge American tech stocks, right? We've seen them just explode in value. They've become such a large chunk of the S&P. Obviously, as my biggest investment is the S&P, so I own a chunk of them as well. I think they're at like 30-something%, right? So largely because of that, we've missed out. And our industries haven't been quite as quick growth, and we've had some challenges, obviously. A lot more money flowing down to the south. So all sorts of reasons why the TSX hasn't been up, but he's saying he thinks 2025 could outperform. The 13th annual forecast, he's saying that he expects the TSX to outperform the S&P by up to 2%, 200 basis points. And he says, look at this, value and cyclicality. and an increase in stock picking. So yeah, he's calling for the index to win against the S&P. The S&P that he still expects to go up 13%, which is not a loss by any means. But he thinks that stock picking, so picking specific stocks, value, so he's not really talking fast growth, he's talking about cyclicals. And I can imagine a lot of the same kind of stuff. As we scroll down here, we kind of jump over his specific price prediction. That doesn't really impact me as a long-term investor, but he's talking about Canadian REITs and financials. Sounds pretty familiar, right? Again, I'm not enough of an expert in the REIT space to really want to talk about that, but financials, I understand that. He's talking probably again about the same kind of cyclical turn, talking about interest rates. I can see all of that. He's given caution with healthcare, caution with telecom and consumer staples. Canadian consumers at a bad point. Telecom has been struggling, right? They're kind of in a weird spot. Healthcare is hit or miss in Canada quite often. And he's saying you have to buy the higher liquidity areas. To me, this is him saying, pick some big names. Pick big, strong, firm companies that can actually make it through whatever kind of chop there's going to be in the next little while. He expresses his confidence in small cap Canadian stocks over the next decade. He's saying for long-term investors, that's probably where you want to be. I'd agree, right? Small caps give you the best opportunity for returns. I'm not always buying small caps, but I do like them. And he's pointing to growth in the S&P. He, in the S&P, likes energy materials. So within the US market, I mean, I like energy materials. I've just been focused on Canada, so I respect that. He wants to go underweight in healthcare. He's talking about large cap becoming the new consumer staples. Now, this is something I think we should be a little interested in. Do you remember earlier we talked about how valuation is never great for timing, but it's always good for long-term investing? A lot of these big tech companies, large cap companies, are priced for perfection. It's hard to get big stock growth out of them because everyone expects them to do awesome. So as they continue to do awesome, that's just the expectation. The stock price will usually stay pretty steady. Probably going to increase, but we're not seeing like giant jumps. It's when you don't expect the awesomeness, right? So when one of these companies has sort of misstepped or fumbled, and then you see one of them turn it around, that's when you get some huge jumps. We saw that recently with Meta, who had their big sort of down and up as they sort of spent a bunch of money in the metaverse. Investors got kind of mad, and then they showed a bunch of profitability. We're probably going to see it with Google, right? We've seen some down, we've seen some up so far. We'll see where that goes. I expect it to go up a whole bunch. Seen it with Amazon as the will they won't they of profitability turned into a will they, and they became super profitable. But BMO is saying, hey, like, listen, everyone expects greatness from these companies. Hard to beat the expectation when the expectation is already perfection. He's not super optimistic for utility and telecommunications. Maybe he's kind of with me saying that the trend buying into stocks that have sort of benefited from the decrease in interest rates is a little played out, right? We've probably put a valuation on those companies that they not deserve, and utilities as a whole time are going to have a hard time facilitating dividend growth going forwards. So all sorts of interesting things. Key points from this thing: stock picking, pick good names, and pick value. I want to sort of take this just to the camera here and wrap this all up. There's a couple of things I want to talk about because we've just seen two investors who are arguing, yes, it is time to invest in Canada. 2025 is going to be a good year. I mean, BMO has even put a target on it, 15%. But as a retail investor, as somebody who's putting my own money that I'm saving at the end of the month into stocks, particularly into Canadian stocks, I think there's a bunch of important advice that's going to really apply over the next couple of months, maybe years. And the number one is patience. Do not go out there after watching this video, toss some leap options on the table and say, I got this. TSX up 15%. Beautiful. I can, leverage myself and make multiples on that. That's terrible advice. If you're taking that from this video, please do not do that. The other thing is, it's probably time to start picking favorites. The TSX as a whole has a pretty high concentration in some really high quality companies, yes. But when you're looking at cyclicals, it's probably time to start picking favorites. That's what I've been doing on this channel the whole time. I'm not necessarily buying into sectors as a whole. I'm usually sort of picking my winners and losers. Now, I could be completely off and miss every single big winner, and people who bought the sector could totally destroy me over the next 10, 20 years. But having done research, having built strong investment theses for most of the companies that are in my watch list and all of the ones that are in my portfolio that I've talked about with you guys, I feel pretty confident. I've picked ones that I think can outperform. Now, I'm always here learning, and that's important, but I've picked really good companies, and I'm going to continue doing that. And as we're only really 6 days away from potentially tariffs on the Canadian economy, from huge economic change, we're only a couple of months away from probably the next election in Canada, and again, huge political change. It's not time for me to be throwing money that I can't afford to lose into the market. It's not time to mortgage the house. It's not time to sell the farm. Instead, it's time to sit on my hands and be patient. I'm going to have money ready. I'm going to be making some allocations into companies that I really love, but I'm not going to be throwing it all into the market just because people are bullish on the same things that I am. Just because I've seen people who agree with me does not mean it's time for me to sort of amp up the aggressiveness. Instead, if people really want to take those risks, I respect it. But as a long-term investor, my risk management is my number one skill. Charlie Munger's biggest quote is that the most important thing is never interrupting the compounding process. So I'm not going to be out here risking it all, risking my portfolio on what I think are probably going to be really good plays. Like if you could have bought Agnico Eagle 12 months ago and made 60% in a year, or better yet, bought Leap options and made hundreds of percent, of course you would. You'd go back in time and do that right now, but you can't. And I don't know that 2025 is going to play out the way we expect it to, because just as much as I can find articles to talk about that are praising the Canadian economy, that are talking about all sorts of things and interesting areas and sectors to invest in Canada, we can go out there tomorrow and find a whole nother slate of videos telling people not to invest here. And I think that's a really important thing to point out, is that while I agree with these folks, while I think they have some really interesting things to say, I really value their insight, I think it's more important for us as retail investors, as folks that are risking our own money, that are not institutional players, that don't intend on making big trades, that aren't sort of like swing trading in and out of things. It's important for us to sort of sit on our hands, go take a walk, right? Go hang out with your family and pick your favorite companies and do your research and really dive into some of the firms that you think fit these trends. Yeah. But then wait, give it a week. And if you want to make some small allocations, love it. I'm going to be doing that. I'm going to be sort of in the next couple of weeks seeing how the chips are falling and starting to make my allocations. But we're not going to see the full outcome of the drama in the Canadian economy for, I would say, more than a year. I would say we're going to see turmoil and volatility for more than a year before we see exactly how things play out. And so it's not time to risk it all. That's about all I have for you folks today. I really hope you enjoyed the video. Let me know in the comments down below. What do you think of these kind of reaction style videos where I'm sort of looking at places like Bloomberg and videos like that, or reading through articles? I really just love this stuff. I love watching this stuff. It's why I have a channel where I talk about this stuff. It's all just about learning and investing and trying to sort of work our way through and making important decisions and sharing that with you guys, because that's just something I love to do. And so if that's something that interests you, if you want to see more of these videos, please let me know in the comments down below. Leave a like on the video and subscribe to the channel. We talk about investing in Canada every week here on the channel. Subscribing is free and it means a huge amount to us. And with that being said, I hope I see you in the next video.